On the 17th of January 2015, the Singapore Stock Exchange implemented a change in the minimum board lot size, reducing it from 1,000 to 100. The ostensible motivation was to increase the attractiveness of trading to retail traders. Recalling that the job of the regulator in each jurisdiction is to ensure that market design changes such as this face and pass the dual tests of fairness and efficiency, collectively referred to as market quality, the question we therefore need to ask in the wake of this change is how did the change impact market quality on the Singapore Exchange? This is the key objective of the market quality dashboard, which we will now use to demonstrate the impact of this change. Unlike other exchanges, such as the Australian Securities Exchange, which switched to no minimum board lot with the introduction of electronic trading back in 1987, the SGX has maintained a minimum board lot size of 1,000 shares for many years. While this provides no impediment to trading in lower price securities, higher price securities end up having very high minimum values, which is thought to discourage retail traders. For example, a stock with a price of $10 must be traded in a minimum size of $10,000. This suggests that as a first pass, we need to look at the trading behaviour of groups of stocks with different traded prices. We begin our analysis by going to the Groups tab within the Market Quality dashboard and selecting stocks with prices above $2. For comparison, we also examine stocks priced between 50 and 70 cents and 5 and 10 cents. As expected, stocks with higher prices see significant declines in their average trade size from around 16,000 to 6,000, while stocks priced between 50 and 70 cents were down from an average of 6,000 to 3,000 per trade. However, lower price stocks, less than 10 cents, exhibit almost no change in the average trade size. This suggests that those securities which were most susceptible to the minimum board lot did in fact encourage much more frequent smaller orders. Second, we examine the number of trades in each group. If we saw far more retail traders in the market, we would expect there to be a significant increase in the overall trade count. The result shows that the stocks priced above $2 experience an increase in total number of trades from around 40,000 trades per day to just over 100,000. The market as a whole saw a similar increase from around 70,000 trades per day to 200,000. This indicates that there are far more orders, the majority of which are of smaller size. The question is, has this led to an overall increase in the level of trading in the marketplace? Examining trade value, we see little discernible evidence of an increase in trading value. This likely indicates that the reduction in trade size and the increase in trade count is driven by the reduction in the average trade size of existing orders, rather than an increase in the participation of retail traders. To investigate the impact of these changes on market quality, we examine quoted and effective spreads as proxies for market efficiency, and information leakage and dislocation of the closing price as proxies for market integrity. While the quoted and effective spreads are slightly higher in the Christmas and New Year's period, we see very little evidence of any change in these measures of transactions costs in the wake of the change. An increase in retail traders would generally be expected to result in more uninformed traders, reducing the adverse selection component of the spread. We see no evidence for the stocks priced above $2, nor the market as a whole. Turning to the integrity of the market, we examine measures of end-of-day price dislocation and information leakage for the market as a whole. We see no significant change in these measures of integrity. Overall, therefore, while it's possible that the reduction in the minimum board lot has encouraged retail traders to participate more fully in the market, we do not have access to proprietary data on client identifiers and therefore cannot address this question in particular. Rather, the results show that there has been a significant reduction in the average trade size and an increase in the number of trades, and few other changes to the efficiency or integrity of the marketplace. In summary, therefore, it seems that while retail traders have had their access to the market improved, that has happened without any material harm to the market quality. But equally, there's been no increase in market quality either.